Hello, how are you all? My name is Parthik Bhimani, and today we are discussing about the leverages. The leverages is an investment strategy of using borrowed money significantly. The use of the various financial instrument or a borrowed capital to increase the potential returns of the investment. Introduction. The financial leverage or generic in the United Kingdom and Australia is any technique involving borrowing fund to buy anything, hoping the future profit will be many times more than the cost of the borrowing. This technique is named after the lever in physics, which amplifies a small input force into a greater output force. Because the successful leverage amplifies the comparatively small amount of money need for the borrowing into the large amount of profit. However, the technique also involves the higher risk of not being able to pay back a large loan, meaning the financial leverage result from using borrowing capital as a funding source when the investing to expected expand the firms and assets based on the generated returns on the risk capital. Leverages is an investment strategy of the using borrowed money significantly the use of the various financial instruments or borrowed capital to increase the potential returns of an investment. Factors affecting financial leverages: second state leverage, financial stability, financing decision, interest rate, stability of the firm, return on asset, fixed financial cost. Leverage and its types. In a business language, in a firm has a fixed expense in a profit and loss account or a debt in a capital structure. The firm says to be leverage. Financial leverage and operating leverage. First, let's see the financial leverage. It is a leverage created with the help of a debt components. The higher the debt, higher would be the financial leverage. Operating leverage. It is the leverage is created help to the fixed expenses in the capital structure. The higher the fixed expense, the higher the operating leverage. Let's see the pros of financial leverage. Earning shares of shareholder will be increased significantly. Pros of operating leverage: profit increase with the small change in a sales. Let's see the both the cause of operating leverage in hurt the risk of bankruptcy. Fixed expense extend the bank even point of the business. A difference between operating leverage and financial leverage. Operating leverage is related to the investment activities. The financial leverage is more concerned with the financial matters. The fluctuation in the EBIT can be predicted with the help of the operating leverage. The change of EPS due to debt equity mix is predicted by the financial leverage. The EBIT is earning before interest and tax, and EPS is earning per share. The financial merger used to use the operating leverage to identify the items of the assets side of the balance sheet. The use of the financial leverage is to make a decision in the liability side of the balance sheet. The operating leverage is used to predict a business risk. Financial leverage is used to analyze the risk. Why is financial leverage is important? The financial leverage is important as is create opportunity for the investor. The that opportunity comes with the risk, and it is often advised that the new investor to get a strong un- understanding of what leverages is, what potential downside are before entering leverages positions. Financial leverages can be used strategical to position a portfolio to capitalize on winner and suffer even more when investment turns sour. Let's see the example of leverage. It's a company formed with the 5 million investment for the investors, where the equity of the company is 5 million. This is a money the company can use to operate. If the company used debt financing by borrowing 20 millions, it now has 25 millions to invest in business operations and more opportunity to increase the value of the shareholders. Yeah. An automaker, for example, could borrow money to build a new factory. The new factory would able to automaker to increase the number of cars in produce and increase the profit. Instead of being limited to only a 5 million from investment, the company now has 5 times amount to use the growth of the company. Limitations of leverages: if a winning investment are amplified, so are losing investment. Using leverages can result in a much higher downside risk, sometimes resulting in a loss greater than your initial capital investment. On top of that, brokers or contract traders will charge fees, premiums, and margins rate. Even if you lose you trade, you will still be on the hook of extra charges. Leverages also has the potential downside of the being complex. Investor must be aware of their financial position and the risks that inherited when the entering into the leverages position. This may require additional attention to one portfolio and a contribution to of additional capital should their trading account not has sufficient amount of equity per their brokers require. Advantages: investor and traders use the leverages primarily to amplify profit. Winners can become the exponential more rewarding when you initially investment in is multiplied by the additional up upfront capital. In addition, using a leverage is also you to access more expensive investment options that you could not otherwise have has access to with a smaller amount of unfunded capital. Leverages can be used in a short term low risk situation when the higher degree of capital are needed, for example during a acquisition or a boycott buyout. A growth company may have a short term need of capital when will result in a strong mid to long term growth opportunities as the opposed to using additional capital to glamour to risk. Advocates leverages enables smart companies to execute opportunities at the ideas moment with the intention of existing their leverages position quickly. Thank you so much.